talk some earnings kicked off this morning. Banks not exactly the start that bulls were looking for. David Traynor joins us, the CEO at New Constructs, where they are digging through earnings to find out where numbers are being exaggerated, understated, inflated, and with a skeptical eye, I might say, David. So where should we be most skeptical this season?
Well, in the S&P 500, we identified 5 stocks most likely to miss because they make a bunch of unusual gains into their earnings. That includes American Electric Power, PENN National Gaming, Howmet Aerospace, Excel Energy, and Robert Half International.
Now, what triggered these on your analysis? What are the flags that flew here that were apparently red?
Yeah, so we go through, and in all of our research that's available to all the TD Ameritrade clients, we actually do unparalleled work on understanding the real number, what we call core earnings, proven by Harvard Business School and the Journal of Financial Economics. Anybody you want to ask, it's the best number in the business. And so then we run those numbers, our number, against street estimates. And across the S&P 500, these 5 companies that I just mentioned jumped out as having the most overstated earnings estimates based on our core earnings estimate.
Okay. So when you're looking at some of these companies that are weak, you've got also ones that are likely to beat. Let's start with the weak ones first. You mentioned PENN. What's going on with PENN? Because that was a pretty hot trade at the start of the year, and it's been a lot less hot since.
I love it. It's funny. It's a gambling stocks. Anything related to gambling's been hot. I'm with you, Oliver.
That's right.
Most of what we find with PENN is actually on the income statement. A lot of times what we find in terms of unusual items are off income statement or in the footnotes. And that's data that effectively has been proven that no one else has. You'd think that the income statement stuff would be adjusted for out of analyst earnings. And that's a big assumption that people make. It's false. Analyst earnings are not always adjusted for unusual items. And so for PENN National in particular, there's about $123 million in other income over the last 12 months that we're pulling out related to a bunch of different things. We net against that about $7 million for the trailing 12 months in impairment charges and another $1.2 million on loss of extinguishment of debt. So again, we're netting everything out, right? So I'm not just saying, hey, they're unusual gains. These are unusual gains, the net of all the unusual expenses, so that we're giving people the true number or the true distortion in every company.
Okay. So interesting. David, what does history tell you in terms of how these expectations live up to reality, and what happens if you're right and the companies don't make it? I mean, are these stocks that we would expect to have like big moves? Are these areas to try and play volatility around earnings?
Yeah, so we wouldn't be talking about core earnings if it weren't proven both by the academics and by practitioners to be a better indicator of stock price performance. And we've got multiple strategies that our quant clients use to take advantage of the distortion number or the difference between our number and analyst numbers or accounting numbers. And so the earnings distortion, or this number we're talking about today, for these stocks in particular, this is a short-term indicator. Most of what we do is very long-term focused on fundamentals, but we have now designed or curated our product to give people more of a short-term indicator, and this indicator we're talking about today is a beat and miss indicator. So we're talking about for PENN National, they're more likely to miss because the unusual gains that have been boosting earnings by virtue of their being unusual are not expected to recur. So over time, they're going to run out of cookies to take out of the cookie jar to boost the numbers. And the real and the reported number will then be lower than expected because they can't fake it anymore.
Interesting. Okay. So those are the ones that might be in trouble, as you mentioned. We got a list of ones that might have some potential to surprise companies likely to beat this season. And you've got a little bit of the kind of reopen theme here. Wynn Resorts in there, Live Nation as well. So the flip side here, I guess we take everything you just told us and invert it, and that's how you found these companies?
That's exactly right. They've got a lot of unusual items, and on a reopening trade or these reopening type companies, that would not be too surprising given that they had a lot of bad stuff going on over the last 12 months, and they're coming out of that. And we think as that normalizes, earnings power is going to be stronger than expected because the street has not done a good job of pulling out these unusual items. And a lot of people are surprised by this, Oliver. Like, well, why would a company ever understate their earnings? Well, there's a lot of reasons why you want to have understated earnings. Number one, it's a good time to issue options because the stock price will be depressed. But it also sets up for strong beats in subsequent periods, right? You have a bigger earnings growth number. You have a bigger sort of return over the prior year because you artificially depress numbers in prior periods. And we see this constantly. We see it across the entire S&P 500, as we've shown in some other research, where the operating earnings, which is supposedly the S&P's adjusted number for earnings, showed a much more drastic and deeper decline in profits than our core number. And on the flip side, we're seeing a much more drastic and steeper improvement in earnings on the back end. And companies like this, and we've seen this all the way through history, going back to the tech bubble, post-tech bubble. When times are bad, throw the kitchen sink at it, clean your books, everybody's unhappy. Nothing you do that's going to beat them, that's going to make numbers look good is going to help the stock anyway in a pessimistic or bearish environment. And so when the bullish environment comes back around, time to juice the numbers because then you'll get extra credit when the animal spirits are more lively.
All right, so we're looking for WYNN, Live Nation in particular here. Tied into that, you also highlight CenterPoint Energy, CNP, T-Mobile, and IPG Photonics as well. And then, David, just to hone in real quickly on Wynn Resorts as an example here, is this just the notion that with all the stress there and uncertainty tied into Macau that maybe they have just kept a lot of their potential positivity at bay and might deliver something a little bit more positive in language? Do you think that the gap could be closed of your analysis versus the core earnings? I mean, do you think that gap gets closed through language where they could just sound differently on their guidance?
You know, what drives the stock from one day to the next, right, is anybody's guess, Oliver. Absolutely, if the company signaled that things were looking better, I think people would take that to heart. I think if numbers turned out to be better than expected, where there are less unusual items pulling the earnings down, and earnings, the reported and analyst earnings, really revert closer to something to the core earnings, that would all be good news for the stock in the short term. And you'd see, I think, a pop based on that because it's a lot of negative sentiment there. And the numbers have not been good. And they're actually, what the street's talking about is worse than what the core earnings number. And that's never a good thing.
All right, David, thanks for the update here. What to look for, what to avoid. Maybe a little relief in WYNN and Live Nation, maybe a little more pressure on PENN. Thanks for the analysis, as always, Mr. Trainer.
Thank you. My pleasure.
You got it. David's the CEO at New Construct.